Hello, chart watchers, and welcome to this Wednesday, March 27th, 2019 Market Watchers Live Show with your hosts, Tom Bowley and Erin Swinlin. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. All right, let's take a look at the market. We are seeing some selling today. The Dow Jones Industrial Average currently down 206 points. The S&P 500 down 27, back below 2,800. The NASDAQ down nearly 100 points. Threatening to move below its 20-day moving average and its earlier low from Monday. The Russell 2000 down nearly 20 points. 10-year Treasury yield down another 4.5 basis points, 2.37%. The slide continues. Volatility index picking up, although as we break to lower lows, you can see the volatility index has not yet broken out to a new high. I'd watch that 18 level. Healthcare, one of the weaker areas of the market, along with energy. Of course, energy had a good day yesterday with crude oil up near $60 a barrel, but we are pulling back today. One area of the market that really standing out, home construction, making a big breakout. If there's one group that likes the lower interest rates, the lower Treasury yields, it's home construction, being reflected there in the breakout today. Within that consumer discretionary space, though, gambling stocks breaking down to the downside. Software also seeing some profit taking in the technology area. And then looking specifically at an individual company within home construction, Lennar Corp reported its earnings. They did come up a little short on the bottom line, but the market doesn't seem to care. We are breaking out on Lennar. Okay, Erin, it's hump day, middle of the week. I'll tell you, the market every day, it's like, what is it, Jekyll and Hyde?
Absolutely.
I don't know what market we got. Today we got a bad one.
And it didn't start off that bad. So,
yeah, well, I tell you, I've been spooked for a while by the 10-year Treasury yield continuing to drop, because to me, that's the bond market telling us that things are not great. The Fed finally came around and said, you know what? We kind of agree with the bond market. Scrap those rate hikes that we talked about. We're not going to hike rates anymore. And now they're actually talking about, maybe the new Fed chief coming in, possibly lowering interest rates. That's, some rumors out there. So anyhow, who knows, right? But we do have a special guest with us today, Doug Busch from chartsmarter.com. Doug, how are you doing today?
Doing great. How are you guys doing?
We are doing great. I'm doing great anyway. I can't speak for Erin. How are you doing, Erin?
I'm super.
Well, I was just good. She's super, so
right there.
She's doing a lot better. Where are you at, Doug?
I'm actually just outside of New York City in Astoria, in Queens. So yeah, not far from the city at all.
Okay. Yeah, I've been up to Long Island quite a bit, and actually one of our fellow bloggers here at StockCharts, Julius DeKempenaar, was presenting at the Traders Expo last week or 2 weeks ago.
Oh, very nice. Very nice. I attended one day. I can't remember which one, but yeah, very nice. Nice outfit over there.
Yeah, no doubt about it. Have been. That's one of the better ones for sure. But anyhow, you've got a presentation coming up. I know everyone looking forward to hearing your presentation. So we're going to bring you back about 15 minutes or so, if that's okay.
Sounds great, Tom. Thank you very much.
Awesome. All right, Erin, I say we go ahead and get this party started.
Indeed, indeed. All right, upcoming schedule. Tomorrow, Dan Russo is going to be with us from Chaikin Analytics. That should be great. And then next week is StockCharts.com's 20th anniversary. So, and that's no April Fool's joke, by the way. That is for real. So we're going to have a lot of special shows next week for you. All right, as far as today's agenda, we have Doug here to start us off after the technical news. 10 and 10, the first symbol is going to be NEO. And the final segment, we're going to look at stocks that we feel have hit a turning point. And go ahead and take the poll, because it does have a little to do with turning points. All right, let's go ahead and get started with our technical news and headlines. Go take it away, Tom.
All right. Yeah. Well, first of all, there were no economic reports of significance, although we did get the international trade out, and that came in much better than expected. But I'm just going to go ahead and jump right into the 10-year Treasury yield. And this is what I was referring to at the open of the show. I mean, March has just been a disaster been great for Treasury buyers. The Treasury prices have been rising significantly, but you can see the yield's been falling off a cliff. And normally when you see a falling yield like that, that's generally an indication the bond market does not like what it sees ahead in terms of economic strength. So you could look at this and say, well, maybe a recession's coming, or you could just look at this and say, well, maybe we're not going to get the kind of strength, economic strength that was previously expected. And right now I'm kind of in that camp, just because some of the other things I look for in terms of recession just aren't appearing. But I do still think this is a warning sign for the equity markets. And I think that's causing a little bit of the volatility that we're seeing now in the market here over the past couple of days. But 10-year Treasury yield continues to drive lower. And until we get a reversal here and start to move back up, because remember, when the yield's rising, it's telling us that Treasury prices are dropping, and that money that's coming out of Treasuries is then available to move over into the equity markets to help drive prices higher there. It's actually somewhat unusual to see the yield dropping like this while the S&P 500 recovers the way it has in the first quarter of 2019. I'm still a lot of suspicion there. We'll have to see how this all plays out, but I'm suspecting we're going to continue to see more back and forth in the stock market. All right, as far as earnings go, there were some earnings reports out. We had Ollie's bargain outlets. You can see beating top line or beating bottom line. KB Homes, same thing. Paychex matched expectations, and then Lennar, as I mentioned, came up a penny short, but getting a positive reaction. And I think the market is looking forward, looking at those lower rates, and considering that, hey, home building probably not a bad area to be in. Speaking of home building, I'm going to start with that chart. So let's pull up the home construction index. And keep in mind, again, with the 10-year Treasury yield coming down these last couple of months, this has been one of the better areas. So this is a 10-year weekly chart. And you can see since bottoming back in the early part of the fourth quarter, we've actually seen home construction move back up above their 20-week EMA. Notice that throughout 2018, once we dipped below the 20-week, and we talked about this a lot throughout 2018, that I really wasn't going to be interested in home construction until we could reverse that trend of trading below the 20-week. Well, we're doing it. We've been trading above that 20-week and breaking out again today. So I think that is a good sign. The other thing I think that's interesting, I know in 2018, a lot of folks got very bearish on the home construction group. I was bearish from a relative perspective during the year. But when you look at the longer term chart here, I think this is still a pretty nice uptrend that remains in play during the bull market, or since the bull market that started back in 2009. Actually, it was a little bit more like 2011 for home construction. But after moving up, we pulled back. We set an important low, and you can see each low since then has been riding right along this trend line. So I actually think home construction looks very good. Looking at some of the individual stocks within the group, let's pull up Lennar, because Lennar did report. They missed on their top line, missed by a penny on their bottom line, and the stock's up 4.5%. Makes perfect sense, right? But I think, again, the stock market's looking ahead. It likes the lower interest rates for this group. And so you've got a price breakout, and now you've got gap support, both coming in 49 3/4 up to about 50.5. A lot of volume been coming in during this move to the upside. So I think we're seeing accumulation in the home construction space. I think that bodes very well. Also, you can see once we got back to the center line on this daily chart on Lennar, we turned right back up. Anytime we've got that PPO above the center line, it's telling us that we're still in an uptrend. So I think this breakout was very timely, coming off of a PPO center line test, and I think the group overall looks pretty good. One other home construction stock that reported, and that was KB Homes. They reported yesterday after the close, and KB Homes missed on their top line, $811 million versus $828 million. So they missed by a pretty good margin, 2.5% or so. And bottom line, they beat, but you can see breaking out nonetheless. The market, again, you can see the money rotating in as we're making these breakouts. Volume is picking up. I think this is a really good sign for the home construction group. However, neither of those two stocks are stocks that I would be particularly interested in. I think there are some better ones, one in particular. And the way I get to this is if you go back to your dashboard and under member tools, go into industry summary. And I always use the table view, but you can pick whichever one you use. If you click on home construction, which you can see clearly is the leader today, click on this, and then sort it by scooter rank, and it'll give you a listing of the stocks in scooter rank order. And you can see there's some other stocks before you get down to Lennar, and certainly before you get down to KB Homes, which actually KB Homes is right here. But LGI Homes, I think this is a really nice looking chart. After moving up back in January, huge move up, breaking out above prior highs. And you can see we continued moving up. We did run into a little bit of weakness in the middle part of March, but we held on to the gap support, and we came right back up. Another one with some really strong volume, making this breakout. I think LGIH is perhaps the best looking within the home construction area. Here's a weekly chart. You can see actually we moved up above the 20-week moving average at the end of 2018. And if I pull up the home construction chart, you can see it wasn't until a week later that we actually made that break. So we were starting to show some pretty good relative strength. And the other way I like to show this is on that relative chart of mine. So let's pull up the LGIH relative chart. Here is your breakout. You can see we are breaking above all these prior tops that we had, whereas the overall group has not gotten up there. So what does that mean? It means you got a really improving relative strength in this particular stock. And the relative downtrend line has now been broken with the strength this week. So I think you got a really good stock. LGIH now relative to the S&P 500, trading at about a 10-month high. And you can see home construction just making a breakout to about a 7 or 8 month high relative to the S&P. So this is an area that I certainly would be at least considering at this point. All right, actually, let's take a look at a couple of these other earnings reports that came out. Paychex did just match estimates. I think the negative divergence here is a problem. Higher prices, lower PPO, made a false breakout earlier today in reversing. I think we're going to go back down to the 75 area on Paychex. I still like the stock. I like the uptrend, but I believe we've got slowing momentum. With a possible catalyst being earnings, we failed, and now we're trading back down near the low of the day. The overall market has negative divergences that we've been talking about. So I think we're going to probably struggle here in the very near term, and then perhaps start to make a run in the overall market as we get closer to earnings season. Oh, let's see what else. How about Ollie's, OLLI? Gap down, held the recent lows, and now has moved back up again. I have problems, though, with this stock on the relative chart. I think there are others now that have kind of taken the lead. Here is Ollie's relative to the broadline retailers. We saw a lot of relative weakness. We are starting to see some strength, and you can see that here turning up. But I would just say this. If we go back down and we lose this prior low, I'd be careful with Ollie's. All right, let's see. There were a couple other earnings reports. Let me pull one up. SCWX. This is SecureWorks. It's a cybersecurity company. I actually like this stock, but I don't like the reaction to its earnings report. They did miss on the bottom line. They beat on their top line by a couple of million, but they lowered their quarter one. Actually, no, I'm not sure. I don't have the guidance on this one. I'm not sure what they did with their guidance, but I can tell you this. Traders not really excited about the report, taking out recent lows. And you can see that the relative strength that this stock enjoyed heading into February has completely eroded. And now we're back at about a 4-month relative low on the stock relative to its peers. I'd have to see a big reversal or something take place before I would be interested here. Okay, Erin, upgrades and downgrades. I'll let you head into that so we can get to Doug's presentation. What do you got?
All right, let me get right to that. Okay, so we did have a handful, not a huge amount today of upgrades and downgrades, but let's go ahead and get started with C-Trip. C-Trip was upgraded today by Bernstein from a market perform to an outperform. Travel and tourism, as you can see. We just got a PMO sell signal. It looks like it came in yesterday, and we did get a little bit of a breakout going on right now, up almost 2.5% on this upgrade, but we should expect the breakout to the upside from this symmetrical triangle. It's typically a continuation pattern, so we're looking for the upside breakout. But getting that PMO sell signal certainly would give me some pause about whether it will actually make that breakout to the upside. But on the upgrade, C-Trip's looking pretty good, testing that resistance there above the top of that symmetrical triangle. All right, Jack in the Box, and I have to confess, I ended up with, I think, yes, 2 that were food related today. Jack in the Box has been upgraded today by Gordon Haskett from a hold to a buy. I noticed right away, of course, the PMO buy signal that looks like came in probably yesterday. If it didn't come in yesterday, it certainly is today on this almost 1 3/4% move to the upside. I spot a short-term double bottom here coming off of the declining trend that started back in mid-February. We got the breakout yesterday, which really confirmed that there was a pattern. Today, we certainly are getting a decisive breakout. The expectation in the shorter term is up here at around $82. However, with that buy signal intact, a new 5-20-day EMA positive crossover, I think you could maybe even look at this one as a turning point, sitting at a turning point, which is what we're going to look at later in the program. All right, Morgan Stanley upgraded Lumentum today from an equal weight rating to an overweight rating, and they've moved their target from $55, obviously we hit that today intraday, to $65. So they're looking for a move to come up and test the resistance up here at these tops we saw back in September and October. What I did notice when I was doing this is an ever-increasing slope on these rising bottoms trend lines, and that is usually the key to recognizing a possible parabolic in motion. Of course, we've seen some nice consolidation going along as we've made this, but now it got to that point. It was going to be time to make a decision. Are we going to break down from that or set an even steeper rising trend? And it appears with the breakout, we might be getting ready to set an even steeper rising trend. I think the PMO looks great. It's confirming this move to the upside. You had a couple of what I would call bull kisses came down. The PMO did, but didn't have the negative crossover and then continued higher. And then, of course, you can see the scooter on Lumentum is just about ready to hit the hot zone. So I think that we do have some more room to run here on Lumentum. I would be looking for an upside target, probably similar to what we see Morgan Stanley put in at around 65. All right, next one up, Papa John's. All right. And this one was upgraded by Stifel today from a sell to a hold. So not the best vote of confidence there. At least they're saying you don't have to sell it anymore. And if you own it, to hold it. I'm looking at it. I think the trend is starting to get a little bit stale to the upside, just because my PMO is starting to get a little bit on the overbought side. However, when you look at just what's happened in the last year, we can see the PMO has gotten down to -6. And past that, which means the upside of the typical range for the PMO is going to be at about +6. So we didn't quite get there in November with the PMO, gave it a good shot there in October and November, but then came completely out of that overbought situation into deeply oversold territory. I think there is certainly time, and it's not as overbought as it looks, is really the bottom line here. All right, let's look at a couple downgrades. Acacia Communications, Morgan Stanley downgraded it today from equal weight to underweight. So certainly not a vote of confidence here. And their target right now is at $44. Just under, it looks like, this area of support that lines up with those tops back in January. We did get a breakdown from what was a rising trend here using in the thumbnail. You can see I used the bottom from here and the bottom that we had 2 days ago, and we're now breaking down from that. Certainly there's some support at $50 in the short term, but I would be expecting to see this one come down and certainly test support at the 47.50 level, especially given this PMO sell signal that's come in. And then also, we talk about confirmation with volume. Notice that, volume, OBV volume has been moving upward despite this decline in price. And to me, that is a divergence that I'd want to consider, because if you can't get the volume to push it to the upside and you're still going down, that should give you concern that we're not going to be able to maintain any kind of rising trend. And then finally, Kronos Group was downgraded by Canaccord Genuity from a hold to a sell. And, you know, we were already seeing some big problems with 3 days of a test of that 50-day EMA. And finally today we just got the breakdown, a capitulation here by Kronos Group, and now we have tested and gone below the $18 mark. I would look for even more downside at this point. The PMO is starting to put some distance and margin between it and its signal line as it just travels pretty much straight down right now. So I would expect more downside, and agree with Canaccord on the downgrade here. All right, that's all I had for upgrades and downgrades. A couple of extra ones in there that you might notice. Skechers, Ralph Lauren were upgraded. American Water Works, Kinder Morgan are a few others. I'll have this slide up in the Market Watchers Live recap later today. All right, Doug, time to bring you in. I'm dying to hear what you have to talk to us about, and I know our viewers are as well. So you ready to go?
I'm ready.
All right, let's do this.
All right, so let's let me just share the screen here.
I'll be taking your questions in the chat room, guys, so feel free to put those in there, and we'll see if we can get to them at the end of the presentation.
Okay, well, first of all, thanks for having me, guys. It's I really appreciate the opportunity to speak with your people. My name is Doug Busch, as I was introduced before. Just to give you a little background about myself and what I do. I'm a CMT, a chartered market technician. I'm the founder of ChartSmarter.com. It's a service dedicated to technical analysis. Each day I write a report on a major specific S&P sector. In each report, there are usually 4 to 5 high conviction ideas, depending on the group I'm profiling that day. I consider myself a swing position trader with a longer term time frame. You can actually call me, I love the phrase, the cocktail napkin technician. I try and keep it real simple with a pure focus on price action and closing prices. I'm a big fan of the round number theory. There'll be a few examples of that. Gap fills as well, triangles, bullish and bearish, head and shoulder patterns, and I love the candlesticks. I think that gives me a little bit of an edge, since not too many people really focus on them. All right, with that being said, I would like to present 4 themes today that I think can make you money, 3 bullish and 1 bearish. Okay, so as you see here on the screen, my first bullish theme is the semiconductors. They have been surging. I have a little ratio chart here comparing the SMH, the semiconductor ETF, to the NASDAQ. The group seems to have their groove back. They were playing second fiddle to software for a few months there, but the semis, they're beginning to carry the NASDAQ on its back. I know today we're down a little bit, but let's see how we finish out. Perhaps the semis are giving the software some time to rest before they reclaim their top leadership spot. But either way, I think it's a good sign for the overall market. You see the uptrend here on the ratio chart. It's pretty obvious. If you remember, semiconductors last year were one of the first groups to fall apart, and they were never really able to regain their momentum. But that's starting to change. All right, just below here, I have the ratio chart comparing the semiconductors to software. These are 2 of the best performing subsectors within technology. Of course, services is doing very well with Apple, but this ratio chart is comparing the semis to the software. The jury's still out, but this recent strength within the chips is definitely a positive development, in my opinion. Just a couple of months ago, I mean, if you really look back, there wasn't really much to like in the semiconductor space. Xilinx, of course, has been an outlier, a beautiful chart, still is, but there's been some nice moves by stocks like Cree. Like I said, I'm a big proponent of the round number theory. It was stopped at the 60 number. Might be looking to retest the cup base breakout trigger of 5188. Lamb, LSCC looks good in the space as well. But if you take a look here at the ratio chart, you can see this sideways channel. You saw this big move up in late January, and it's seeming to trade sideways here. After it broke that downtrend, it is holding it. It's still in the middle here. I'd wait for a breakout for real confirmation. But the semis as a whole, they are starting to look good here. All right, just below here, I have a perf chart. I like this. I use it a lot on stock charts. It's just an illustration of the the bifurcated nature that exists in all subsectors. You can see the outperformance. If you look at these old tech plays, Xilinx and AMD have really outperformed. Micron and NVIDIA, not so much so, although they might start to do their thing. What is this chart really telling us? This is a space you really want to deploy your capital to. It's just starting to outperform again. And we know that trends, once they begin, they're more likely to persist than reverse. All right, so with each theme, I have three of my favorite ideas. Let's get into my favorite idea right here. KLA 10 core. CLAC is the symbol. It's an old tech semi player, higher by 33% and 10% over the last 1 year period. It has a decent dividend yield of 2.5%. For the guys that like the fundamentals, it's had 5 consecutive positive earning reactions. It's higher 11 of the last 13 weeks, and it's now 5% off most recent all-time highs recorded this week. Keep in mind, all these charts are from about 10:30. I know we've seen a little sell-off, but these charts are all from earlier. The prices could be changing. You see on the RSI, for a good portion of February and March, it wasn't shying away at all from the above 70 overbought RSI number. Had a bullish inside day last Friday on light volume. It did break above a bull flag here. It's about to retest that now. You can also interpret this as a cup with handle breakout. It's still in the same spot. It's retesting this breakout. It's not uncommon at all for breakouts to be retested to test their volatility. I like the way that this chart trades very tight. Bearish names, bearish characteristics, they trade very wide and loose. Now, on the bottom of each chart here, you'll see I like to compare the actual individual name to the group itself. So there's a ratio chart here between CLAC and the semiconductors, and you can just see higher lows making a nice uptrend. Kind of looks like a bull flag here on the ratio chart as well. And here, for those of you old enough to remember CLAC and AMAT, they used to be the two monsters in the group. But this ratio chart is showing you just this very nice outperformance in KLA compared to AMAT. Like I said, CLAC is about 5% off its most recent all-time highs. AMAT is down by more than a third. Very small dividend yield on AMAT as well. But you can see the sideways trade on the ratio chart between October and February. And then it just took off. And it looks like a bull flag on the ratio chart here. Continuation pattern. Look for this outperformance from CLAC to continue against AMAT. All right, my second name within semiconductors, analog devices. This name having a nice year as well, up 23%, up 16% over the last 1 year period, dividend yield of 2%. This one also, nice earning reaction history, 4 consecutive beats, or 4 consecutive positive reactions, if you will. It's up 11 of the last 13 weeks. And like I said, I'm a big proponent of the round number theory. You can see here on the chart, it was held back at 100 last June and last August. And once it burst above, I'm looking for this 100 number, form of resistance to become support. Again, this number is pulling back into this. It recently recorded a break above a 103.69 cut base pattern. It was 8 months long. The longer the base, the greater the space. But I think going forward, this 100 number, the round par number, will now act as support. You see on the bottom here, this ratio chart, analog devices wasn't doing that well compared to the group in 2017, but that changed in 2018, and it's testing the cup base right here. I think higher prices are ahead. As long as it stays above 100, I'm really positive on this name. All right, my third and last play within the semiconductors is Microchip. It's higher by 15% year to date, lower by 12% over the last 1 year period. Decent dividend yield of 1.7%. It's in bear market territory. It's down about 21% from its most recent highs. It's lower for the last 5 weeks, but it had a nice move, 29% combined move during a 6-week winning streak to begin the year. This one has back-to-back positive earnings reactions to inspire a little bit of confidence, make you think things are back on the right track. You can see the move above the bullish ascending triangle. Again, round number theory was held back at 80, right back in the beginning of December, was held back again there in January. It broke above that. You can see actually the 60 number in late October was support within the ascending triangle. So if you measure the width of the triangle, 80 and 60, that's 20 handles. It has a measured move to 100 again. You can see in here, it was actually stopped at the round 90 number, not surprising. It's filling in this gap again from the 2-5 session. And let's see, it's as of right now, like I said, these were prices at about 10:30. It's below the 50-day. Let's see if this 200-day moving average holds up. Again, on the bottom here, we have microchip against the semiconductors. You can see, it has underperformed since February. Like I said, it's down 21% from its most recent highs. But it might be coming into, maybe a triple bottom here. I think this offers good risk reward with a tight stop. All right, let's look to my second positive theme here, energy. As you can see, I have the ratio chart here of the XLE, the energy ETF, over the SPX, the S&P 500. I like how it's taken its time here. Obviously, you can see that steep downtrend compared to the market from October to December. It's starting to bottom out. Bottoms take time. I like that. Just the opposite is tops are, in a more crazy fashion. This group has been in the penalty box, as you see. For the last 5 years, it's been the worst or second worst performer of the major S&P sectors. It's paid its dues. I think we can look for potentially higher prices. We'll take a look at crude here. Again, I'm a round number guy. The 60 number, this is obviously yesterday's closing prices, but it looks like 4 out of the last 5 days, we're just flirting with this 60 number. It's being held back there. Markets have been taking their cue from crude, remember. Oil and markets bottomed together on Christmas Eve. The energy equities, it could be a tailwind, this stronger crude price. Some of them are acting well, some are acting better than others. We'll get into that. But you can see here on WTI, we had a nice bullish inverse head and shoulders pattern, broke out, was retested a couple times, which morphed into a bull flag. And now it's going up again. I like the way this is shaping up here. I think once it gets above 60, I think it can get above the 200-day moving average pretty quickly. There's been a lot of bad news about it, about oil, but it seems to be shrugging it off. That's very positive action. All right, so let's get into my 3 favorite energy plays. All right, British Petroleum, integrated energy giant. We're all aware of it. Higher by 16% year to date, 13% over the last 1-year period. Big dividend yield, 5.6%. It's had 4 consecutive positive earning reactions as well. Not huge moves, but you're not going to see huge moves from a big super tanker stock like this anyway. But still, give it credit. 4 straight positive reactions. It's had good digestion with that break above the 200-day moving average for the whole month of February. It kind of flirted with trying to go back beneath it, but bulls held it. We had a golden cross last week. I think you can enter here with a retest of this bull flag breakout from 313. You can see it's right here. It needs to hold here to not break that series of higher highs and higher lows on the RSI. Again, I'm a big price guy. Price overrules everything. The bull flag breakout on the 13th of March. Keep in mind, it rose more than 3% on double average daily volume. I really like volume on breakouts. The breakout carries a measured move to 47. It's been digesting the move nicely here. You can see the volume trends. Again, on the bottom here, I'm comparing British Petroleum to the energy ETF. Nice smooth uptrend on this ratio chart. Now let's take a look, just a quick look at its weekly chart. Okay, obviously I'm a longer term guy. I like to take weekly peaks as well. The weekly chart here shows, if it can get its act together, it's well off this double bottom, potential double bottom here of 47.26. But just keep in mind, as technicians, we believe the best stocks give you the opportunities to add on the way up. If it can get its mojo back and break above this double bottom pivot, it would negate this potential triple top. But you can see here, it's up 11 of the last 13 weeks. 2 weeks, there were 2 doji candles. Last week, of course, the gravestone doji candle. As we know, dojis are often pretty good in predicting fatigue from the prevailing trend. It almost moved up 10 points from those December highs. So you might see some digestion here. Remember, on the daily, I like it here. If it can get above 47.26 on the weekly, that's a breakout above a double bottom pattern. Okay, next we have Valero. All right, this is a refiner, obviously. Higher by 16% year to date, down 6% over the last 1 year period. Nice dividend yield, 4.1%. This one, earnings as well, acting pretty good. 3 of the last 4 were higher. Obviously, it's down a third from its 52-week highs. It's underperforming peers PSX and OXY, which are down about 23%. But I think actually that's not right. It's the bullish inverse head and shoulders pattern. It was a break above 83 on the 31st of January. Carries a measured move to 98. Again, this, you can see the sideways trade. I really respect this. I think it's I think the bottoming process is well underway, and I think you're going to see higher highs. And if you look down with VLO compared to the XLE here, we know false moves usually have very strong moves to the opposite direction. If you look, it looks to be breaking above a rounding top here on the ratio chart. So keep an eye on this one. Nice dividend yield, still well off its highs, has room to run. All right, next we have Warrior Coal. Obviously not a traditional energy play, but this name enjoying a really nice year, up 25% year to date, lower by 6% over the last 1 year period. Dividend yield, not a great dividend yield, 0.7%. But what I really like about this name, you can see the digestion had a huge move of well over 300% between June of 17 and June of 18, and it's traded sideways ever since. Again, I'm a big proponent of round number theory. You can see the weeks ending 2/22, 10/19, that should be an 18, and 6/8/18 were all above 30 intra-week, but 0 were able to close above them. You can see the reversals there. It's actually up nicely today. Of course, this is a weekly chart, so I really want to see this close above 30. Obviously, like I just mentioned, 3 other times it was well above 30 as well, but failed. But nice support recently at the rising 50-day on the weekly chart. And I think you can add to this above a 30.67 double bottom with handle pivot. Remember, this is the longer chart, longer the space. Longer the base, the greater the space. Again, let's take a look here at Warrior compared to the XLE. Actually, a better comparison would be right here below against the coal ETF, KOL. Keep in mind, KOL is pretty liquid. I think it trades about 25,000 shares a day. So, but the instrument, it does give you a good idea of what's going on within the industry. If you take a look at the ratio chart here, it shows HCC strongly outperforming the coal. HCC is just now 4% off its recent 52-week highs. KOL is 23% off its own recent highs. Peer, of course, we know Peabody now 37% off recent 52-week highs. That looks like it's going lower. It's weighing on coal. All right, my third positive theme, staples. Under the radar, we have our staples, the XLP, the Consumer Staples ETF, comparing it to the S&P 500 here. As you can see, there was some strong gains in October against the S&P as investors, became more defensive The ratio chart ended up giving back about half of those gains. Looks well rested here. It looks like it's turning up again. Let's keep an eye on that. It's higher 10 of the last 13 weeks. Now trades just 2% off most recent 52-week highs. We'll take a peek at the year-to-date performance below, but on a one-month look-back period, it's just 1 of 5 of the major 11 S&P sectors higher by more than 1%. So anticipate this group to hold up well on a relative basis, not necessarily an absolute basis. Well, it could absolute as well, but if these markets return to their volatile ways, I think investors will return to these names. All right, year-to-date performance, as you can see, still up over 10%. Again, this is around 10:30 prices this morning, but you can see all the 11 major S&P sectors here. Technology, obviously, it's a good sign overall, up almost 19%. But again, you're getting capital appreciation here. You get a nice dividend yield of 2.8%. It's only outperforming the materials, financials, and healthcare. But again, every sector is up so far year to date. Very good showing. All right, let's get into my favorite 3 staple buy ideas. Number 1, Hormel, SPAM, food products play. It's higher by 4% year to date. 32% over the last 1-year period. Decent dividend yield of 1.9%. Acting anything but defensive, of course, as we said, it's just 4%. And these are recent all-time highs. It's behaving much better than their peers. Conagra, which actually had a decent earnings report, I believe. Kellogg's, Campbell's, all down. You can see well into correction toward the bear market territory. I don't have to tell anybody what happened to Kraft Heinz recently, but some of these staple plays, if you really look, you can find some gems. On the bottom here on the ratio chart, you see Hormel against the staples. It looks like it's rounding out a bottom pattern and looking higher. On its daily chart here, you can see the 44 number was resistance a couple of times. And the bottom upward sloping line within the triangle found support a few times. Finally broke above 44. That's your trigger in a bullish ascending triangle. And you can add to this above a cup-based trigger, you can see which engulfs the pattern above a 46.36 close. I like the space between the 50 and 200-day moving averages with both sloping higher again. All right, my second favorite staple idea. General Mills, nice breakout. I mean, this looks like a tech stock. Staple name showing great strength, up 33% year to date. Beautiful dividend yield, 3.8%. Last week it rose almost 7%. It's higher by another 1.7% this week so far, showing great follow through. Very stubborn, not giving back any of that lofty gain last week. And this has produced 2 straight nice earnings reactions as well. Again, round number theory guy, powerful close above the 50 number sets the stage for the move to the 60 figure, which was resistance back in late 2017 and early 2018. We like to see, most breakouts, most obviously good breakouts, the best ones work out right away. You want to see good action post breakout. This you can see did just that above a 45.10 trigger on February 19th, digested the move very nicely, then burst above a little short consolidation this week, demonstrating excellent relative strength. Look at the volume, very nice volume here. I think you can enter this on a pullback around 51. All right, you see down here again on the ratio chart, comparing the individual name, General Mills, to the staples. Nice, smooth uptrend. All right, my last staple idea, a Mexican play, Fomento Económico Mexicano. It's a beverage play. It's higher by 7% year to date, 3% over the last 1-year period. Slow mover. Dividend yield of 1.5%. Last week it was higher by 2.7% as the S&P fell 0.7%. Good relative strength, nice action. It's been trading between the round numbers again of 80 and 100 for the last 14 months. I think this gets pulled magnetically toward the round par number. Last Friday ended a 5-session winning streak, closing the upper half of the daily range on that ugly tape that we encountered, which also found support at its 50 and 200-day moving averages. I think you can enter here as it finds support against those averages again. And again, the best stocks are going to give you a chance to add on the way up. You can add to through a double bottom trigger of 93.85. Notice here, steep downtrend was broken nicely, held right here. This is actually a bullish morning star pattern with its spinning top candle in between. This bearish engulfing candle had no follow through to the downside. Decent sign. Again, here on the relative strength chart, you see Fomento downward channel here, broke above it, but now it's testing this here. Let's see if it could, kind of move higher out of that little downtrend range there. All right, my last theme here is my bearish one. It's on the financials. Obviously, we know there's been a lot of talk about the inverted yield curve, but this group has been it's been weak for some time. We take a look here at the XLF, the major financial ETF. Trades 12% off its most recent 52-week high. Last week, terrible week, fell almost 5%. By far the worst showing of any of the major 11 S&P sectors, I believe. The materials were down just 2%. So there's a lot of space between 10 and 11. On a year-to-date basis, it's just ahead of healthcare, up about 8%. And again, big proponent of closing prices as well. This chart shows the importance of that. And keep in mind, the best breakouts work right away. This group was never able to touch. It came close, but not touching the overbought 70 RSI number in the last 6 months. Shows you it's been a laggard. And here again, we had a bullish inverse head and shoulders breakout above 27 on the 18th of March, reversed hard that day, forming a bearish dark cloud cover candle. Obviously, that showed some follow through to the downside. And notice the accelerating volume last week between Tuesday and Friday. Volume grew with each day as it fell. You can make a case here, spinning top candle. I mean, I wouldn't call that a morning star pattern, but this is a group here that, to me, it's got investors' hopes up so many times, and just as it looked like it wanted to break out, got hit back down again. Let's take a quick look at the ratio chart comparing this, the XLF to the S&P 500. I mean, if you turn this chart upside down, it would look unbelievable. We talked about the inversion on a 1-month look-back period. It's the worst performing major S&P sector. And on a 3- and 6-month look-back period, it's the second worst actor. Classic chart here. You can look at this as the staircase up, bloom, 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 elevator down, bloom, bloom, elevator down. All right, quickly here. I know I'm running out of time. Let me look at my favorite 3 financial sell ideas, interactive brokers. This was a leader. It shows you not to fall in love with names. They can turn very quickly. But this name is now lower, 7% year to date. Obviously, we know the market's had a nice rip, and it's lower 24% over the last 1-year period. It had that huge move, as you can see here, rose 43 of 56 weeks. Very consistent, nice tight trade. Look to the right of it, you see kind of volatile bearish trade. It's been down 27 of the last 43 weeks. Now trades almost 40% off most recent 52-week highs. Just any stock that hasn't participated in this big move since Christmas Eve, that's a red flag. Big caution there. You can see here on the weekly RSI, continually hit right at the 50 number. You've got a symmetrical triangle here. You could short this with a sell stop below 49. As a measured move to 33, you get that from measuring the 16 handles in the width within the triangle. Very hard to underperform on a lagging group, but this is exactly what this stock is doing. Lower highs. All right, my second name, Jefferies. up 6% year to date, lower by 17% over the last 1 year period. Decent dividend yield, 2.7%, has not recorded back-to-back weekly gains since mid-January, as the market has been ripping. Breakdown occurred the week ending, October 12th of last year, fell 9% in the strongest volume in the last 11 months. The break was retested multiple times and held. You can see slightly downward sloping neckline, not that uncommon. Broke down below it, tested it again, tested it. So really looks like it's fallen off here. I mean, it's hard to short here. I would wait for a little bit of a snapback rally, maybe around 1950. But again, as you look here on the ratio chart, very poor showing here on the ratio chart, making lower lows for years now. All right, my last name, the exchange play is CME. Down 13% year to date, higher by just 3% over the last 1 year period. Dividend yield of 1.8%. Down 6 of the last 7 weeks, and now is down 15 of the last 17 sessions. Could make it 16 of 18. This one, we spoke about some of the semis that had very good history of earnings reactions. This one's just the opposite. 4 consecutive negative reactions. And you can see here, I mean, it broke below. It's been above this rising 50 weekly day for a long time. Finally broke below it. As I said, most breakouts or breakdowns are commonly retested. I would wait for a move back into 166 to short this. Again, 2 recent 3-week losing streaks right here. Again, the last 3 weeks prior to that, there were just 2 times that it did that in the last 2 years. So pretty significant. On the ratio chart here on the bottom, you can see a bearish head and shoulders here, broke down and is continuing to the downside. So that's my report today. Any questions or?
Yes, actually there is. First of all, great presentation.
Thank you so much.
Yep, really enjoyed it, Doug. And I loved you talking about the candlesticks because I'm a huge candlestick fan. So
love it, love it.
Yeah, you had my attention there. I follow the candlesticks pretty closely. There was one question in the room, and actually they asked about 2 stocks, but I'm going to give you one of them because the other one is a little bit lower liquidity, and I didn't think it looked as good technically. But this other one's a small one. It's NOG. So the question was, what do you think of small energy companies? And let's use NOG as an example. What do you see here?
I mean, look, I'll be totally honest with you. I very rarely follow stocks under $5. Just looking at it from a pure price project, I mean, it's kind of caught here between the 50 and 200 day. I would be more positive. I could see this above 3. Looks like it's bottoming. I mean, like I said, the energy group, I'm kind of positive on. But yeah, this is a play. For me to be bullish on this, I need to see it over $3.
Okay. It's funny because this is one I think that I included yesterday on a segment that we did called Under the Radar. And this was one that I actually picked out of the energy space. And the reason I did is I kind of like that volume that's come in here over the past 2 or 3 weeks to the upside. All of a sudden we've got
yeah,
there.
It does look strong.
All right. I got a question for you though.
Absolutely.
And I'm going to let you, maybe give this one some thought. I'll go ahead and show my screen. And all right, so this is a chart of the dollar. And I got to agree with you on the one hand about crude oil prices going higher and the fact that's a nice little driver for the energy stocks. However, energy and materials have both been battling this overhead or headwind in the form of the dollar. And so I've gone back the last 20 years and showed the dollar declining during the last bull market, the one from 2002 to 2007. We had a declining dollar, and energy and materials led that bull market rally. In this bull market, though, the dollar's been moving higher, and both of these groups have been underperforming the S&P 500 as a result of a stronger dollar. So I've been torn, actually. When I look at energy stocks, I tend to walk away from them because of the headwinds of the dollar. So my question is, do you follow the dollar, and do you think that the crude oil prices rising will overcome the falling or the rising dollar, or what are your thoughts there?
It's hard to say. I mean, look, it's obviously a traditional intermarket relationship. The energy group, to me, I mean, to me, it does sort of remind me a little bit of the financials. Every time it seems to get a little lift and you're getting a little bullish and you're feeling better, it just careens lower again. So it's probably a group I wouldn't trust. Yeah, I mean, look, the dollar does look good here. I like these ratio charts. But, you know, as long as the price action within these energy names, if it can shrug that off, that's a very positive development for me. But, you know, let's see what happens. But I agree with you wholeheartedly there.
Okay. Yeah. And a lot of times when I look at a chart like this and I see the energy groups underperforming, but I like an individual stock, I usually preface it with the idea of, okay, I like this stock, but knowing that it's part of a group that's been underperforming, if it starts to fail, you don't want to sit there and make too many excuses for it.
Not at all. Not at all.
So we're kind of
to go one bit further. I mean, you know, I would tend to wait. I mean, if I'd keep it on a radar or a watch list, because once if that group does turn around, that name will probably one of the strongest first ones out of the gate if it did show good relative strength while the group was struggling. But I agree with you.
All right, fair enough. Well, we enjoyed having you today. We certainly would love to have you back sometime. Great presentation, Doug.
Thank you so much. Thank you guys for having me, and I'd come back anytime.
All right. And there he goes. And remember, that's chartsmarter.com. So check that out if you enjoyed Doug's presentation.
Yes, I definitely did.
Yeah, I thought it was great. And I love the candlestick part because, again, I love me, I love the candlestick.
Oh, yes. I'm going to start looking at them more. I say that every time I finish our shows, and I just never do. There's always other things to look at. So it's just those short-term patterns. It just doesn't work for my trading strategy usually, but
yeah. Well, I know for me, I mean, when I look at stock charts and all the different things that we can get, price and volume are the combination that I need. That's the one thing I have to trade with. But I would say the second thing is candlesticks. I mean, I don't think I can trade without candlesticks. I guess, you know, I've been doing it for so long, and most of my trading, because it is short term in nature.
Oh, it's perfect for you.
Yeah, I mean, it gives you a lot of indication of what maybe market makers are doing, because they trade the market, but they trade it very short term. They don't buy and hold for long periods of time. So I think the candlesticks can give us some really good short term clues.
Oh, absolutely. All right. Well, I did pull up the RRG just to get ourselves started here. Not a huge number of requests, which means Doug was very interesting. Looks like industrials, though, actually won out today as far as which ones were requested. So, all right, let's go ahead and start, though, with NIO.
All right. Yeah, I don't know what's going on here. The stock looked like it was making a breakout at the end of February and into early March, and you can see the volume picking up. Everything looked really good. And for a stock to go from $10.50 to under $5 in about 3 weeks, yeah, I would say that's certainly worth being aware of and being cautious. And it isn't falling back on light volume. I mean, that kind of a drop, you'd expect it to be on big volume, and it has been. So it seems like there's a lot of bailing going on in the stock, which that's not something that's going to interest me. So I'd have to see at least the stock begin to show something from a technical perspective before I'd be interested. And that something would be at least an initial move through about 540 or so with some volume. I mean, if it's a light volume move to the upside, I'm going to be very nervous and skeptical. But yeah, I mean, when you look at it, the stock versus the auto group, which I've said before, I'm not a huge fan of autos in general anyway, but this is an auto stock. It's underperforming its peers. It's been a really wildly underperforming stock versus the S&P. And you can see here, autos just not good in 2019. So I would personally pass on the stock. I don't see anything here that I like at this point.
All righty. Let's see. The most popular in the chat room today is Tandem Diabetes, TNDM.
Yeah, this is a really nice looking stock. I think you got great support still sitting at 60. It's in the medical equipment group, which has been a great outperforming area of the market, even though healthcare hasn't been that strong. I know we talked about this one a few weeks ago when the stock had pulled back to around this gap support area. I thought it would bounce off of it. It did. And now today we come right back down to a low of 61 at this area. This has been where the buyers have been coming in the last 2 times we've been at this level. So I would be a buyer of TNDM at this level. If it fails to hold and you get stopped out, I think we could go back down into the lower 50s, maybe even to 50 to test gap support. But I wouldn't assume that's going to happen. I would actually be on the other side thinking that we're going to bounce off the 60 area.
All right. Sounds good. How about Kinder Morgan? That one was actually downgraded today. I just didn't cover it.
All right. Kinder Morgan. Beautiful move up. It's probably got a negative divergence. Let me just see that on another chart, and then I'll come back to this one. Yeah, here's your higher prices and lower PPI. I could just kind of tell it looked like it was getting tired. But the volume has been pretty good on the move to the upside. So if it loses the 20-day moving average, I think you might see the 19 level come into play. But this has been a really strong stock within a strong part of energy. Pipelines have been very strong in 2019. And you can see on a relative basis, this has been a great stock within the group. So if there was one area in energy that I might be focused on, it'd be pipelines. And I think KMI is a good one. I would just be looking maybe because of the negative divergence. You might get this one a little bit lower. I'd say 19 might come into play here.
All right. Our only comm services request, Live Ramp Holdings, and it's Ramp.
All right, Ramp. Okay, Ramp. Well, you've got great gap support and price support that are going to come together somewhere in the upper 40s and lower 50s. You got a stock that's actually been doing pretty well. The problem is media agencies on a relative basis have started to turn back to the downside. This has been a pretty volatile group. I mean, you get outperformance, fall apart, outperformance, and now they start trending lower again. It's been a group that we really can't trust very much, unfortunately. But this stock has been an outperformer. So I think that you've got a nice breakout right here. You can see that prior high in September, and then we kind of drifted sideways to down for a while, and then we made the breakout. First time we came down, actually two different times we came down, we tested the 51 area and held. So that would be the first key area of support, and that's right where the 50-day moving average is. If you wanted to be a little bit more conservative, you could maybe just enter half position at 51, and if we were to work our way back down to about 48 to the top of gap support, that would be my other entry. And if it closed below 48 or whatever that open is here, that's where I would be out. So I think there's still some possibilities here, even though the stock has been weak for the last 4 days.
All righty. Let's see. Next one up. Big name for you here, JP Morgan.
Yeah. Unfortunately, it's just in a bad group. I mean, you know, Doug was talking about the financials. I completely agree. This is a group that's been very weak, and banks have been, and life insurance companies have been two of the weakest areas of financials. And the reason is that declining treasury yield, the 10-year treasury yield that I spoke about at the beginning of the show going straight down. That's really cutting into the net interest margins on banks. And the market knows that. So when you see the 10-year treasury yield declining, it tends to sell off. We tend to see a sell-off in the banks. So I think we got some problems. I think right now we're consolidating, because I think, again, the market is mixed as far as, is the economy going to strengthen? Is it weakening? Some might say, and I think maybe a small percentage, but there might be some who think we're going into a recession. I think there's a lot of question marks, and one of the groups getting hit the hardest as a result are the banks because of what's going on in the bond market. So a couple of problems I have here. The JP Morgan's been downtrending relative to the S&P during this year because obviously the banks have underperformed. It is, however, still okay, I think, relative to its peers. So if the banks would get going, then we might have a shot here with JP Morgan. But the biggest problem with JP Morgan is really not JP Morgan. It's its peers. And right here, as long as the banks keep going down relative to the S&P, I think JP Morgan's going to have a lot of problems. So for now, I would avoid it.
Yeah, lots of headwinds.
Yep.
All right, let's see from the industrials. Let's look at GATX Corp, GATX.
Yeah, just kind of going sideways. You can see the group going sideways, relative performance going sideways, underperformance versus the S&P. So I'm not seeing anything that really gets my attention here. I focus a lot on relative strength, and I'm just not seeing a lot here. If I just strictly focus on the price action, I think we could look at the recent lows and say, okay, we got a little bit of support here, maybe around 72, short-term resistance up closer to 80, and maybe we just trade this range for now. But I like to trade momentum. I don't like to trade ranges, directionless charts. So I personally would avoid this one because of that.
All righty. Let's see. Next one up, also an industrial, Nordic American Tanker Shipping, NAT.
Yeah, another one that's been drifting lower for a while. These shipping stocks, I've lost enough money. I've paid so much tuition on shipping stocks that I don't even trade them anymore. And once look at this chart. I mean, it looks great volume, and all of a sudden just falls apart. I have run into that so many times. Look back here in June, breakout, everything looks good, it falls apart. These stocks, for whatever reason, and maybe others have much more success with them, but for me, I can't trust their moves when they make breakouts. Their tactical breakouts don't seem to last. So I am very biased. I have a negative personal bias group, just being honest. As far as the chart goes, if we want to take a look at that, we got some pretty decent support coming in closer to 180. Recent high at 235 provides you a little bit of resistance. I think it trades in that range, and let's see which way it breaks out. Although, again, I'm not sure I'd trust the breakout, but technically that's what I'd look for.
Mm-hmm. All right. Let's see. From discretionary, how about Six Flags Entertainment? 6.
Okay, well, I like the group. I like the discretionary stocks.
Mm-hmm.
You can see recreational services. We're doing okay. Actually took a little bit of a turn yesterday because of Carnival Corp's earnings. But this group, or this stock, you can see is really a laggard. Look at the relative strength of 6 versus recreational services. So if you've got a group that's starting to turn lower relative to the S&P, and you're in one of the worst stocks within that group, I just can't endorse anything like this. So I think that the stock's got some work to do to repair itself. Again, I'm going to be more of a fan of stocks that are showing relative strength, not relative weakness. Volume trends are not good. I would avoid it.
Okay, let's see the next one up, and I used this a little bit when I was house hunting. Zillow Group, Z.
Yeah, Z. I really thought, I still think that this gap support is going to hold. I think it's a really solid reward to risk trade at the moment. You can see that on a relative basis versus its peers, it's not great, but we talked about this one not that long ago. It made a big move relative to its peers on this gap up, and now we've worked our way all the way back down to where we were on that gap. So I like the reward to risk. I don't like the relative strength, but I do like the relative strength of the group. It's just the stock has not been a great performer. However, the stock's at a major support level. So if I annotate, I would just draw one line right here, and that's the line that needs to hold. This is gap support. We have been bouncing off of this now for 5 days. What I am hoping is that it's been light volume. We're getting an accumulation of shares by a market maker or maybe a few market makers, and then we'll make a run to the upside. That's my hope. But hopes get dashed. And if we break below 35 on a closing basis, I would exit, especially if that volume picks up. Do we have another one?
Hope is not the best trading strategy, that's for sure. Final one, Dropbox, DBX.
All right, DBX. It's in software. Look at this stock. Now, we've talked so much about software being a great area of the market, not just in 2019, but really for the last several years. And yet you look at a stock that was trading at $42 in this space back in June, and now it's $21. It's lost half of its market cap during a period when the overall group has risen probably by 15%. I can't endorse that. And again, this just comes back to the relative strength here. And maybe it becomes a great stock. I'm not saying that it can't. I'm just saying the way it's trading right now, Wall Street is shunning this company. And so why should we buy it? I would avoid it.
All right, makes complete sense. That pretty much completes the 10 and 10. Here are the symbols that Tom just annotated for you. I will have all of those charts up in the Market Watchers Live chart list. Just go to the Market Watchers Live blog from the Articles tab, and the link will be right there at the top. All right, we will be right back after this brief message.
Join us April 1st to April 5th to celebrate our 20th anniversary here at StockCharts.com with special guests Arthur Hill, Greg Morris, Gaddis Rose, Martin Pring, and John Murphy.
All right, we are back with our final market update. As you can see, markets are lower right now. Looked like we were taking back some of those losses after hitting an intraday low, but now the markets look like they're ready to turn right back down. Currently, the S&P 500 is lower on the day by, oh my goodness, 0.8% right now. And the NASDAQ also following the biggest laggard, actually, at lower at 1.04%. S&P 400, you can see that small caps and mid caps here trying again to make a move to get out of those losses, but also like the large caps have turned down on the 10-minute bar chart. TSX, Canadian markets, started higher on the day, also hit their intraday low and are pulling back before reaching positive territory. Currently, the TSX is down 0.18%. Treasury yields are lower right now, reading 2.375%. The VIX, we did see a spike here, up just about to 17, but we've pulled back on that right now, and we have a reading of 1594 on the VIX. UUP, the dollar, mostly unchanged. Gold is down. GLD is down 35 cents right now, 123.95. USO has spent most of the day in a decline, did try and make a move back up, but has been, gravity is now taking its toll once again, and it is just about at $12.30 right now. TLT continuing its rising trend from the past 3 days and is up currently $1.07 to 126.04. And then very quickly, our leading sector right now, if you want to call it that, sectors are materials and industrials, because they are down just under 0.25%. Our big time laggards right now, down over 1%, would be healthcare and technology. And that's all I have for my portion of the final market update. I'm going to pass it to you, Tom.
All right. The S&P 500, and we've talked about this for a bit, all the way up, you can see that the PPO was continuing to rise. Once we pulled back, had this one pullback, and then came back up again to the upside, that's where we got this negative divergence. We have failed to hold the breakout level, which was at about 28.17 was the level that we were watching, and we're trading back below that. So keep in mind that on a daily basis, the S&P 500, along with all the major indices and many of the sectors and industry groups, are struggling with divergences, negative divergences, and that can lead to a little bit more consolidation and frustration and even some selling like we're seeing today. I did want to just mention on the 60-minute chart, because this is what we talked about the other day. Normally, when you get into an uptrend, you stay above the 20, and then when you get into a downtrend, you stay below the 20. Well, yesterday we had moved above the 20. We came back down below it, back above it. Now today we're below it. When you start doing this kind of behavior with moving averages, to me, you're more in a trendless market rather than a trending market. So I just drew a couple of lines. I believe if we break down below, say, 2783, 2784 on the S&P, I think we're likely to see more accelerated selling, perhaps testing that early March low around 2720 or so. If we can hold this area and get back up above that 20 and start trending, then we'll be in better shape. But again, this all comes with the perspective of what's going on in the daily chart, which in my opinion is somewhat bearish in the near term. So we just need to be careful here, especially if we lose these recent lows.
All right. Makes lots of sense there.
All right. Well, let's head into turning point. And Erin, I will let you start. Go right ahead.
Okay, so I did end up using a scan today, and when I use scans, I do try and put them into the Market Watchers Live recap. So if you want to copy them and use them yourself. For the turning points, I decided today I wanted to look at stocks that had just had a PMO positive crossover and that had a nice setup as far as the EMA configuration. So I wanted the 20 above the 50, above the 200. And then I was looking for sort of mid-level scooters, some quite, almost in the hot zone or just barely into the hot zone. And so I got my list and I put it into Candle Glance. And I had, of course, lots of these to look at. And from that, as I went through, and I could try and explain everything I'm looking for, but typically I'm looking for the right setup of a PMO, a scooping move to the upside, and then I want to look at price action where you're getting a move off of some support or you've had the pullback. So those are the sorts of things I'm looking for. So my first one I ended up picking was Columbia Property, CXP. And I'm still liking the real estate group and the REITs. They still keep coming up a lot on my scans. So I looked at this as a turning point. Number one, because you do see that the PMO has bottomed and it has started coming up and it's about ready to make that positive crossover. And you already have an OBV that has been showing a rising trend with the rising trend that we had started already back at the end of February. So I like that setup. But the other thing is you got a short-term breakout here. It came up, it broke out, and then it had to pull right back down, and now it's making its move again to the upside off of that 20-day EMA. Now, granted, we do have overhead resistance looming above at $23, but because that setup looks so good, I think with the PMO and everything else, I would be willing to go in with the expectation it would get above it. If it got there, kind of pulled back, and then we weren't able to get above it, then that might be the time to exit. But for a shorter term trade, I might make that effort. If you're looking at a weekly chart, you can see that $23 level. If we beat out that level, we should expect a move to test some of these highs we saw back in 2018. And the PMO, I think, is still looking pretty good. It's certainly not overbought on the weekly chart. A little bit of a volatile looking one, though, isn't it? All right, the next one I ended up pulling up was DKS, Dick's Sporting Goods. I came in through, it was a lot of different things. So here you can see that scoop on the PMO. Like I said, it's just turned up. You've got that breakout right now. This looked like it could have been like a reverse flag or, even a symmetrical triangle. And those are continuation patterns. So the expectation here was the breakdown. The PMO was already moving lower, but we managed to get the PMO, the momentum to shift upward. Despite it took a little while, but the last 2 days it certainly got it there. And now we've got that breakout above the 20-day EMA, and we're trading well above it. So I like this one. $37 could pose a problem as just intermediate, the intermediary resistance. But I would still be looking for a move up to that $39 level. I think this one has hit a turning point. And look at the 20, turning up just above that 50-day EMA. Scooter improving. I think Dick's Sporting Goods looks really good to me right now. All right, next one I had was First American. And this is in the financial space. And while I'm not a fan of the financial space, and I think Doug covered it, there's still lots of times you're still going to find pretty good performers there. And I would say that First American's looking that way. Now, honestly, it is slightly late to the party here as far as the declining trend that was broken here, that declining tops trend line. However, right now we're just getting the breakout above 52, and I like that. There could be a little bit of a resistance here at 53, but I like this powerful breakout. We might get to see it come back just a little bit intraday, which would make it a little bit more enticing, I would say. But nice PMO turning up above the zero line, still plenty of room for it to move higher without getting overbought. I think that this one looks pretty good in the financial space. The next one, interestingly enough, is Hormel, and I overheard Doug talking about it, and so I thought that was very interesting that we both picked this one out of that space. And I'm going to take this here so that I can annotate it right real time for you. So what I was looking at as well is here's that overhead resistance that was beaten out, and then you could really make a case here for rising bottoms right here. And if you don't include that last one, you can really see the rising bottoms. And that is an ascending triangle. And the expectation was that breakout. And we got the breakout. And now we're seeing it pull back to the $44 area. Perfect area to pick something up. And then we've got $46 as our upside target here for the resistance area. But based on the measurement here, of this ascending triangle, I think you could see it overcome that resistance at that November high. So I know it's in the staples area, but if we are going to see a little bit of a pullback in the market, this might be an area to consider. And like I said, seeing a 0.75% move to the downside off of that, I think looks pretty good. And then finally, I'll just throw REG up here. That was my other one, Regency Realty, another REIT. PMO buy signal already here. You can see the breakout above that 66.50 level. I think it's sort of hit the turning point, but the breakout that we've seen over the past few days, I think that's a calling card, and I would look for higher prices. All right, Tom, I'm going to pass it to you. There's the weekly too. I thought that looked really good. If we get over that 67.50 area, look at that. Nice, nice potential there.
All right, are you done?
Yep, I'm all done. Let's go for it.
All right, here we go. I'm going to go with Fortinet, FTNT. This is in the software space. And one of the things that I would look for, the stock's been moving down, but it is coming off an uptrend. It's in that nice software area. And it's had recent lows down around this 80 area. So we're sitting at 81 and change. I think it's getting close to a turning point. Now, as Doug mentioned, he follows the candlesticks. I do as well. I really like it if we had a tail that went down below 80, below the 50-day moving average, and then we come back up, because that suggests to me that we have a false breakdown, which normally is an indication of accumulation by market makers. So that's something that I would be looking for. But FTNT is one that certainly is worth mentioning. Align Technology. I wrote about this one in my blog this morning, in that it likes the current time period of the year. It likes the spring. And you can see that certainly over the last couple of months, we've been moving up really nicely into spring. We got overhead resistance that we have to watch, but we made a breakout at about 264 or so. And we've come back today and we're testing that level. So this is an area where we could have a turning point and another push back to the upside. Salesforce.com, CRM. CRM had a false breakout up here and has pulled all the way back, but we can see that we broke out at about 153, and we've had a couple of lows coming in here in the low 150s, looking back in February and March, and here we are again. Now, the volume was heavy in early March on the selling. If we lose 150, I'd be careful, but again, it is in that software space that has been strong, so I tend to give those stocks a little bit more of benefit of the doubt. And as we get down closer to the support level, I think you can keep your stop very tight. Data, D-A-T-A. This is Tableau Software, another one in the software space. And software, by the way, has really taken a hit here over the past 3 or 4 trading days. You can see many of the stocks pulling back after leading for a long time. But this one's got pretty good support around 120. We hit 120 and change earlier today. Square. Now, Square is squarely on this support from earlier in March, and I would want that to hold, because if you look down here, financial administration stocks have been doing extremely well, breaking out above prior highs. Square has not. So you've got a stock that has been rolling over relative to its peers. If it fails to hold price support, I would not be making excuses for it. Instead, actually, PayPal in this space is doing a lot better than Square and leading the group to the upside. KDMN. This is a smaller company, and it's a biotech. Been downtrending, but I do like that increase in volume in February to the upside. And notice where we pulled back, right to 260. Multiple times trying to get through $3, but each time we get back down to around 260, we bounce. Today's low was $2.62. So this is another one I think that is worth watching. Auto, AUTO. This is Auto Web, specialty retailer. I've talked before, I think specialty retail, when we go back here, one of the strongest areas, trying to make a major breakout versus the S&P 500. If we do that, you can see auto has been a great performer versus the S&P and versus specialty retail over the course of the last 3 or 4 months. So this move to the upside, accompanied by a lot of volume. One negative on here, and I don't usually show charts with light volume. This is one that certainly has light volume. Only 18,000 shares today. So it is coming back down. It's hitting a major support level, definitely at a turning point. I would avoid it because of the light volume, but I saw it on the chart, thought I would go ahead and mention it. And FAF, this is one Erin just mentioned. So we did we looked at these stocks from two different angles, came up with two different or the same stock on both of our lists. I'm actually going to say, though, on a turning point basis, just like on those that were going down, looking at price support as a possible turning area, I think we want to be careful how this stock finishes today, because we did get up into breakout territory above the February high earlier today. We're still holding the breakout, so I'm okay right now. Volume is not going to be weak. So I think this breakout needs to hold into the close. If the stock were to close back down, say around 51.5 or below, I would be a little nervous with it in the short term. I think it could be a short-term turning point where maybe we go back down and consolidate in this range off of the uptrend. So that's how I would look at First American. Breakout, though, I agree would be very bullish. Okay, that is it for our turning point stocks. You can see the stocks listed there. And we kind of had a poll running today, and we're going to go ahead and take a look at that here in just a second, because we wanted to know what things you all might look for in terms of turning points in your trading. So we pull those up. I know, I talked about candlesticks, Erin. That's a big one for me.
Yes.
Here's the list. What do you think?
Well, I pretty much picked, picked all of them. I think I left out the test of the moving average because I really do pay even more attention, I think, to the patterns, the PMO, of course, and sentiment. And I read sentiment as volume, what's coming in on volume, that sort of thing. But yeah, I mean, I've never really used the candlesticks because my trading horizon is a lot longer. And candlesticks, as we've talked about, that's a 1 or 2, maybe 3 day formation that, is giving you information. So it just doesn't work for me that much. But
yeah, I mean, I'm looking at the list, and I would say, and we said topping, bottoming, PPO, PMO, MACD. That can mean different things to different people. I know, Erin, when you're looking at the PMO, you're looking at it relative to where the PMO has been in the past. So if it's getting up close to that prior PMO and starts to roll over, that kind of gives you a topping signal. Mm-hmm. I look at the PPO and used to look at the MACD and in terms of negative divergences. And so that would be, I'm trying to think of, well, I mean, I could just pull up the S&P 500 and we could take a quick look at that. Yeah. I've talked about the possibility that we're topping short term. And well, let me pull it up on a regular chart here. But I use the PPO when I see higher prices in the lower PPO as a possible topping signal, as a possible turning point for the market. Not necessarily long-term turning point, but mm-hmm. It's a short-term turning point. That's kind of what we're seeing right now. Mm-hmm. But yeah, as far as the different poll results, I know that the one that was the lowest one was the extreme sentiment. And I would suggest that more people pay attention to that. I know you do a weekly sentiment update for all of us here on Market Watchers Live. And I think it's a good idea. I don't think sentiment day to day is necessarily a good thing, but I do think having it in the back of your mind and seeing, where it's going, I think that's important.
Oh, absolutely. I know we all pay attention to the VIX. And like I said, I think OBV and watching where volume's going. I know you watch for, excessive volume on a particular day over their average. Yeah, that's kind of a sentiment reading as well. There's interest or no interest.
Absolutely. No doubt. I do want to thank Doug Busch for joining us today. We'd certainly love to have him back again. That was a very informative presentation. Want to thank all of you for being with us today. Please remember to complete the survey as you exit. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everyone. We'll see you back here tomorrow. Happy trading.